Well, I can tell you from a retiree's point of view, there's a switch that flips when you retire. But at that point, were you stressed?
We were, of course, strapped to our desks.
Some NASDAQ and S&P 500 funds like yours rebounded, and some not so much.
I think a lot of people psychologically, critical mass is like 100 million.
I think there'll be a lot of demand for it, put it that way. I don't know what the performance will be like because that's up to the stocks, obviously. But I think there'll be a lot of interest in that. Covered call index funds offer three things that every income investor wants: high yields, consistent monthly income, and the diversification of an index. All that sounds good, but of my top 10 holdings, only 3 of them are covered call index funds. And today we're going to discuss some of the limitations of covered call funds with a covered call fund expert. Garrett, is it safe for a retiree to put all their money into covered call index funds?
Yeah, so I think this more comes back to a question around putting all your eggs in one basket, right? You're not going to do that in any product. It probably wouldn't make sense to do that in a covered call product either. I think one thing that we're always talking about is everyone's financial situations are unique and different. So would you really take all of your nest egg, all of the wealth that you built and put it into one investment? No. So I wouldn't suggest putting them all into a covered call product either. You should have a well-diversified portfolio that's really meeting your individual objectives, not an objective you might hear from somebody else, or a hot one stock that somebody's talking about to put it all into that. So I think it's all around diversification, but covered call index-based products can offer a positive allocation in your portfolio, but again, all within reason to your risk, and income needs.
Right. And every asset class has its risks, which we'll get onto shortly. So I think if you love gold and you invested just in gold, that would come with risk. If you love REITs and you just did real estate, that would have its own set of risks. So just like every other asset class, covered call index funds have their pros and their cons. But having said that, they've become incredibly popular in the last few years. It feels like there's a new one coming out every week. Why do you think covered call funds have become so popular recently? JP Morgan's JEPI fund went from $0 to $40 billion in 4 years, and that's not normal, right?
That's not normal. But I think the investor base right now, a couple of things. One, has access to more research, right? Shows like this being able to help educate individuals on other types of products to allocate in their portfolio besides just long the S&P 500, for instance. The need and the search for income, right? And passive income. How can I generate income in my portfolio, in different ways? And I think covered call products have been able to give investors allocations that we've talked about to core indices like the S&P 500, the NASDAQ 100 in their portfolio, but significantly higher yields than what those indices have normally provided. So if you're at 1 or 2%, maybe in a dividend yield, these tens of products, can be delivering 10, 12, 15%. And so that helps investors really get to their cash flow, their monthly income needs, with exposure to those core underlying indices.
Well, I can tell you from a retiree's point of view, there's a switch that flips when you retire. And before that, everything is about building a nest egg. Build a bigger nest egg, build it faster. The bigger, the better. And then when you retire, it's about cash flow. It's literally, how will I pay for this month's bills? And if you're a growth investor, you sell something. And if you're an income investor, you just get income. But it seems to me like the financial media doesn't really address this. They do talk about growing the nest egg all the time. But the part where, how do you get the money to pay the bills when you're retired, that doesn't feature so much on CNBC. So to me, it seems like these covered call funds address that problem, which is retirees want cash flow. Covered call funds deliver it, mostly in a monthly format if it's an ETF, right?
Yeah, that's correct. What's actually kind of unique in the last few years we've seen is just anyone looking for income. We've actually heard from a lot of investors that even some of the younger pre-retirees are actually using these products for passive income to pay for groceries, their car, their vacations. I think we've seen a large adoption of people just wanting that kind of consistent monthly distribution and an income source, that's able to still be linked to these major indices. So absolutely. I mean, I think these products have really been helpful for individuals looking for income generation.
And I guess traditionally, most people focus on growth for a couple of reasons while they're working. One of them's tax, which we're not going to get into today, but we've covered that extensively in previous interviews, that some of these funds are actually very tax efficient. So even if you have income from a job, you could still put them into a taxable account, but that's for another day. You're a fund manager. I know you're not a financial advisor, but you do talk to financial advisors quite frequently, right?
That's correct.
Okay, so I'm going to ask you a question that's more directed at financial advisors, but I'm still interested in your take on it. Sometimes I hear comments from, and this is more from growth investors, that covered call funds underperform their underlying index over the long term, so you might as well just buy the index. And I think that's, especially if you're new to income investing, that's definitely a relevant question to address. So is that something that's come up in discussions between you and financial advisors?
We do. We have these conversations, and I actually agree with you. I'd answer similar, right? If you're a growth investor and you're willing to weather all the drawdowns and you don't need income on a monthly basis, right? Most people are going to invest in the highest growth, highest risk investment and just hold it and not look at their statements on a monthly basis. Covered call products aren't any different than other income allocations, right? You buy fixed income because you want lower volatility and you want monthly coupon payments. Covered call products are now just the way that you're getting another alternative way within your portfolio to generate that income. And so they will and they should be underperforming, right, their core benchmark over the long period of time, because you're giving away a little of that upside to generate that monthly income and lower volatility during those times when the market doesn't go just straight up, right? And you're an income investor. So
right. Now, over the long term, these rules apply, but it's not as though the underlying index outperforms a covered call fund in all markets, right? There are certain market scenarios where actually a covered call fund will outperform the index. Could you give an example?
Yeah, absolutely. So the three kind of market scenarios are, right, a bull market where you're seeing equities really perform, a slightly higher to flat market, or a negative market. Where the covered call products would seek to outperform is going to be in those latter two markets, right? You might underperform a very significant upward move in the equity markets because you're selling away a little of that upside to generate the income. But in those kind of more moderate to flat markets, you'll generate the income from the call options and from the equity dividends. And then certainly when you start to see those equity indexes sell off, that income you've generated helps you outperform. So kind of 2 out of those 3 scenarios are actually where a covered call product would outperform. It's only going to underperform in those really stellar, months or years where equities are just incredibly strong. But on an absolute basis, you still have a good return because you've participated, right, with some degree of that move to the upside in the equities.
Okay, so let's do some specific examples because one of your funds, and we're not getting into your funds today, but I just want to use an example. SBYI, that began during 2022, right?
That's correct.
Okay, so we can't really use that because it didn't begin on January the 1st, but there were some other covered call funds. I can think of one that's one of your competitors that were around back then. And 2022 was a terrible year for the stock market. And there were covered call funds that outperformed the S&P 500 during that year. So that's an example of what you're talking about. But this comment, I think, comes up more during bull markets when the market's on fire and they see that it's doing incredibly well and then the covered call equivalent is a little bit behind. That's when these comments come in. During 2022, I didn't hear anybody making this comment.
Yeah, no, I didn't either. Right. In 2022, we saw an equity market that pretty much had an unprecedented, just precipitous decline, right? Being down almost month after month after month as the Fed had significant interest rate hikes in the here in the US. And so the way the covered call products can help you in those types of markets are that income that's being generated on a monthly basis serves as a positive part of the portfolio against the declines in the equity part. So let's just take an example. If the S&P 500 was down 10% in 1 month and your covered call product generated 1% for that month, right, to meet your consistent kind of distribution rate, yes, you'd see that the covered call product outperformed by the 1%. So it'd be down 9% versus the 10 of the S&P in a more extreme example. But if you're down 2%, and you generated 1, sure, you outperformed by half, right? You're down 1 versus 2. but you kind of saw the ability to generate a positive part of your portfolio, an income source, when the market wasn't just going straight up, and helped you buffer some of those times when 2022 was very unique, right? All areas of your portfolio besides cash were essentially down, right? Fixed income was down, equities were down, and that traditional 60-40 was a very challenging time for people to be looking at their portfolios because they weren't getting a buffer or any kind of measure of downside protection, from what they thought those core 60-40 allocations were meant, to deliver.
Yeah. Actually, I'm glad you mentioned that 60-40 thing, because that's the traditional way of looking at it, which is 60% equity, 40% bonds. It seems to me, and I'm not an expert on this, but that is becoming gradually less popular over time, and that people want their own take on how to set up their retirement portfolio or just their portfolio in general. So as an income investor, to me, something I like about this type of investing is the lack of decision making. We still have to, everyone has to make decisions, but if you're a growth investor, you have to think about, in a market like 2022, okay, I've got to sell some stocks this month to pay the bills. They're down. The market may go down further next month than it did last month. So do I sell extra now to get ahead of it? Or do I wait and possibly sell when they're lower? And then before you retire, do I buy bonds 40% like you said? Is that enough? Or should I be maybe more risk averse and have 50-50? What happens if the bonds run out? What duration should the bonds be? Short, medium, long term? There's just so many questions. Whereas for an income investor, the money comes in every month. And the only thing we're really thinking about is, will there be any dividend cuts from stocks or funds, which is something we can discuss in a minute. But that's just my take on income versus growth investing in this whole question of, why don't you just buy the underlying index?
Yeah, I totally agree with you. I think this comes back to your first question as well, to put all your eggs in one basket, right? And all covered call products. Having that well-diversified portfolio that's really meeting your individualized investment objectives is the most important. So you're going to have parts of your portfolio that are just long equities and will have all that upside. You should have a part of your portfolio that's these covered call products that are meeting the consistency of the distributions. And then you can look at other ways to reduce maybe some equity risk and some of alternatives, whether that's real estate or gold in different ways. But I think as you think about being an investor in those more troubling times, you want to have the ability to not have to affect change in your portfolio. Usually what we see when we talk to a lot of advisors and institutional investors, the main thing they're trying to tell other individual investors are, just don't touch your portfolio, right? The best case scenario is build a robust, diversified allocation, know where your income is going to be coming from within your investments that you can have as a reliable source, and wait until, right, the choppy waters become calm. And if you've looked even just back to earlier in this year with Inauguration Day and then the tariffs, right, you saw a significant sell-off in equities and then a very close bounce back. And so the less you could touch your portfolio, focusing on your estate planning and diversification, then we see that helps investors over a period of times. And these covered call products can help you stay invested and be less worried about constant portfolio changes.
I agree. Now, you mentioned the tariff thing in April, and I want to ask you about that. So I'm glad you brought it up. I made a note here. April 3rd, the S&P 500 fell 4.8%. I think we all remember that. The next day, it fell 6%. So it got worse, if that was even possible, the second day. At that point, now we know now it would all kind of worked out fine, but at that point, were you stressed?
Short answer is no. I think everything that we do here at Neos is all around time-tested research and, quantitative approaches, so systematic. We're not letting a exogenous, market event on a day or two really affect what the broader part of the portfolio is doing, because we've tested through all those scenarios. And so for us, we were very pleased to see that our products across our entire spectrum, right, did exactly what we had expected them to do. I think for general investors as a whole, not talking about Neos, our products, any type of scenario like that is going to give anyone, right, concern, right? It's going to make them think, wow, I just lost, 10% plus of my overall equity value, in my portfolio. Is that going to come back? Is it going to get worse? It gives people that whole, concern that you were just speaking about before. And so from us, we were calm throughout the whole thing. We watched the markets. We watched everything unfold. We were, of course, strapped to our desks. We were watching things. We were here. but ultimately we allow our quantitative and research-based approach, be focusing on, not just a short-term, unexpected, market move.
Okay, but can you give us something specific, like maybe a specific of a particular fund in terms of what you did? I understand that you have a model and you follow certain systems, but you must have done something different that week than any other week.
So we didn't make any portfolio changes that week. What we had done more specifically in our covered call products were we had entered the beginning part of April with our portfolios in place with our short covered calls. We'd met what we had targeted on our income for the month for investors. And so what we actually saw was the market sell off, right? We didn't roll down our options to try to generate more income because I think, as you might know and some of the audience might know, right, we're always judging the equity upside appreciation with the income generation. So we did not make a change to our overall portfolios. What we ended up doing was we rode that out, and we rode the market all the way back up in the back half of April to where our products performed in line and actually, I believe, had a small outperformance to the underlying equity indexes that ended up pretty much flat on the month because we generated the income in addition to getting the equity performance back.
Okay. And then after those crazy couple of days, was there any difference in terms of your option strategy? Did you sell any further out of the money or closer to at the money than normal? Or did you change the percentage of the portfolio that you write against?
Yeah, so that's a great question. As we ended April and headed into May, when we went to go shift our options portfolio, we actually did all those things that you had just mentioned. Because volatility was so elevated, we actually were able to write our options further out of the money and actually had a lot less of the portfolio, I think more in that 50 to 60% range, depending on the product, as opposed to more in that 70 to 80% range. And what that allowed us to do was meet the income distribution, which is always our first investment objective. But second is capital appreciation. And so we saw a continuation of the equity markets bouncing back and moving higher through May, where we captured a substantial amount of that upside because we had positioned our options in a more conservative way after meeting our initial, income need that we did for investors.
Okay. I think it was interesting actually to look back on that month without naming names and see some NASDAQ and S&P 500 funds like yours rebounded and some not so much. But like I said, we're not going to name any names. Okay, let's move on with a few more questions about kind of the mechanics of the business. Every fund you have uses options to generate income. So you're selling a lot of options. It's kind of what you do, right? Neos, every fund you have sells calls. The question is, who's buying them?
Yeah, so the person on the other side is going to be a long investor. They're going to buy a call option hoping that the market moves higher. So if we're selling, let's just say an S&P 500 call that's 3% away from where the current market is, so-called 3% out of the money, that investor is going to buy that call option hoping that the market moves higher than 3%, right? 3% or greater, because that's where they start to profit. So the investor on the other side is a long investor versus us selling the options in a short nature to generate the income.
And would it be accurate to say they're taking a lot of risk with a smaller amount of money by doing that compared to just buying the stock?
Yeah, that's correct. So options are a great capital investment. And the reason why is it takes a lot less capital to buy your exposure than it would if you just bought all those equities or the ETF that's long the whole, S&P 500. So they're able to use a small amount of money at risk versus putting it all that in case the market goes down, they lose less. So it's a great efficient way to gain exposure within your portfolio for, long investments and or the short investments.
Okay. And what about the depth of the market? There are more and more of these covered call funds, as we said at the beginning. The volume of options being sold clearly is going up. Are there enough buyers, or are you going to run out of liquidity?
There are. Think about any other major stock, Apple, Microsoft, IBM. You have buyers and sellers all day long across the entire globe. And I think I saw a report in the last couple of months. I believe it was from SIBO, so I don't have the actual link to it at the moment, but I think they talked about the current volume of S&P 500 options being traded is $2 trillion a day, right? So it is a tremendous amount of volume going on both sides of it. So same thing. I mean, you're seeing the regular markets, the S&P, the NASDAQ, major equities trade, in large size, and the options market, is right there, following behind it in those major indices.
Okay, so nothing to worry about there. That question's come up a couple of times though. Let's talk about yield. If you offered higher yields on your funds, and some of your competitors certainly do that, you could attract more assets, right?
So potentially, yeah, income investors looking for higher levels of income would certainly come. I think as we think about it overall, you got to marry the income generation with, upside within the equity markets. And so for us, we could generate more income by selling those options closer, but we'd be giving up the appreciation in the underlying equities for that.
Okay, so if you target for a particular fund, say SPYI 12% for argument's sake, how do you come up with that number? I think you use a range actually, but it's not random. So why 12 and not 7 or 15 or 20, or where does the number come from?
Yeah, so we always do have a range, and that's coming out of really two things. First and foremost, the options market. How much can the options market be paying for us to generate income on the portfolio on a consistent basis, right? So we look through short, medium, long-term history of what the options market can reasonably pay us. Also, what is the risk that we're taking for that income, right? How much of the upside of your portfolio will you give up to generate that? And so for us, as we look at that, we're viewing the average monthly return within that underlying index, say the S&P 500, also looking at that in an annual basis and over a full market cycle. And so we're judging what is the risk relative to the income that the options market can generate for us, and how that underlying reference asset, in this case, the S&P, could perform, over a full market cycle, a month, or, a year's time.
Right. Because if I understand it correctly, the long-term performance of the index, the S&P 500, and then the long-term performance of the covered call fund based on that index, they won't be the same, but there'll be a lot of correlation between the two.
Absolutely. Yeah, there's a lot of correlation. So I think from us and our standpoint, we want to look at that. You can't ignore what the S&P 500 is doing, right? If you own the S&P 500 and you're selling calls against it. So that's an important part of looking and assessing the risk for what income, is reasonable to generate.
Right. Okay. That makes a lot of sense. I want to go back to some doomsday scenario, or actually one doomsday scenario, because we talked about the tariff thing in April, and that was dramatic, but it was very quick. So was 2020. But if we go all the way back to 2008, the GFC, the global financial crisis, that was considerably worse and over a much longer period. The NASDAQ fell by more than 40% in 1 year, and it didn't bounce back in a month or a week. It took years to recover. So most of these funds weren't around then. But could you walk us through a hypothetical of a fund like QQQI, which is based on the NASDAQ? What would that look like if it went through a catastrophic market correction like the 2008 GFC?
Sure. So there's a lot of factors an investor has to think about in this, is like, how do we get there? How do we get down 40%? Is it a straight downward trajectory? Is it a sloping, decline? Is it gyrating a lot to where it goes up and down? But I think let's just take from a simple stance to give everyone an answer, is for us, as we look at our NASDAQ product, our QQQI, we're trying to target in that 12 to 15% range. And so naturally, if we saw the NASDAQ 100 down 40%, and let's say it was very orderly, just sloping downward trend, we would look to be generating that 12 to 15% of outperformance versus the equity index, right, that we own as an underlying. I think as you think about other products, the ones that generate a lot of high current income but not upside in those scenarios, right, would have more income and more buffer to the situation. So as you think about a much more prolonged or catastrophic concern recession that's going on in the market, right, depending on the trajectory of how that, plays out, that income generation from covered calls should be there to help buffer you and deliver you that income over those more troubling, months and time.
Okay, so that's the good part. But I want to ask you about the bad part. So we've got the price of the covered call fund, and we've got the income from the covered call fund. the price is going to go down by a similar amount to the underlying. So NASDAQ goes down, let's say 40%. Although it's not going to stay at minus 40% from January 1 to December 31, obviously. It's going to move all over the place. But let's say 40, that's a really, doomsday number. The underlying index goes down 40, the covered call fund would go down, the price would go down by the same amount or close to it. What do you think would happen to the income?
Sure. So depending on the product you choose, and I'm going to talk about us as an example, but I'll try to weave, other competitors in. For us, right, the fact that we're targeting this kind of 1 to 1.25% a month income generation, right, is valued off of what the fund's net asset value is. So if you had a $10,000 investment and we generate, let's say 1%, right, we're generating $100, for the portfolio. If the portfolio is down 40%, your investment is now worth $6,000. If we generated 1%, that's $60. So you could see that if the value of the portfolio goes down, right, the income level being generated, the percentage might be the same, but the actual dollars you're receiving are less. Some other products do it a little bit differently to where they're going to sell more call options and they're going to keep them closer to at the money to still generate you the $100. Where we differ in that is when you do get that bounce back in equities, because you sold those call options to generate the same income, you won't have that equity appreciation. And so we kind of differ in saying we want to make sure we're delivering a reasonable and a consistent amount of distributions, right, for the fund, but you got to be able to protect the overall net asset value of the fund for, let's just say, maybe you're going to ask me 2009, start to see the equity markets come back. You want to be able to earn that 40% back. That's an important part, we think, of these covered call products to generate income, but also understand that you have an equity investment within the fund.
Okay. So the bottom line is that if the underlying index drops dramatically and for a long period of time, let's say a year, the income from a covered call fund will drop as well. It'll still be, say, 14%, but it'll be 14% of a smaller number. There is one other factor, though, and we could talk about this for hours. It can get complicated. But if the market drops 40% for 2 weeks and then it bounces a bit and now it's down 30%, you've got these zigzags along the bottom. The absolute worst point for the market, that's going to be more volatile than the change in income, right? So if the worst day for the NASDAQ is minus 40% for the year, but the average over the year is more like down 20%, then would it be accurate to say that and I know we're creating a lot of scenarios here, but would it be accurate to say that the income is not going to be down as much as the percentage drop in the price of the index?
That's correct. Yes. I mean, I think, you know me, I consider talking options all day, every day in different scenarios, but ultimately you are correct by that. Yeah. As the market zigzags around and or slowly creeps higher, right, those distributions grow back, right? And so whether you're generating more income from volatility being higher or the equity markets and your underlying value of your investment increases, so does the distributions. And so you get much more of an average than it is, I took all my distributions at the lows and I got paid a lot less for the year. That's just a one, piece of a snapshot in time. And the inverse could ultimately happen if markets go up significantly. The inverse could happen for investors as well.
Yeah. And I say that because the tariff thing in April is a good example of a really brief crash. But if I look at the income from, say, SPYI, it didn't, drop dramatically like the market did because it was a short-term thing.
Yeah, that's correct. We kept a pretty consistent distribution through, April into May, but also had a really nice bounce back in achieving the equity participation when the market came back, because that's going to be most important in the long haul as well for investors, is that the value of your portfolio is higher, because then, right, the distributions will be higher over time.
Got it. Okay. Enough doomsday stuff. I've got a few questions for you about kind of the behind the scenes of the covered call business. You've got a few multi-billion-dollar funds that are very successful. That's great. We've talked about them on other interviews. But we've also done interviews on new funds when they're just little babies and they have only maybe 50 or $80 million of assets under management. So my question is, how big does an ETF have to get to be profitable and sustainable so that you can keep running it? Because if it runs at a loss, I guess you would have to close it at some point.
Yeah, so for us here at Neos, I think we view the market a little differently than a lot of our competitors. If we're going to launch a product, we want to be dedicated and absolutely behind it for a really long period of time. We feel that if we're going to spend the time to research and bring something out, that ultimately it has a place in the portfolio, most likely because we've also heard from investors and there's interest in people talking to us about different ideas. Overall, though, to answer your question, I think as people think about having a fund that is small in size and scale, it's relative to a lot of factors such as the expense ratio of the fund, the cost to operate the fund internally for the business, but then also the fund's external vendors. So the lawyers and the administrators and the auditors, the people that are actually billing the manager for the cost to operate that fund. And so I think as you think about what goes into that, right, there's a lot of factors and there's a lot of costs, but you kind of want to see these funds get to critical mass. I think a lot of people psychologically critical mass is like 100 million, as saying like, okay, that's sustainable, right? That's out there. Of course, one manager with $100 million fund is probably not sustainable, but just thinking about a fund in general for investors, I think that's more of a rule of thumb that maybe it's psychological or the industry is just kind of put to it, but you really want to see that kind of 100 million plus within a fund.
Okay. And I guess for Goldman Sachs or JP Morgan, they have some economy of scale and they could afford to launch a lot of funds. And if they launch 103 shut down, no one really notices. But for a smaller firm, if you have, say, 7 and one fails, everyone's going to notice. It'd be more of a big deal. But just to generalize for the example you gave for your firm, for Neos, would it be a rule of thumb that a fund's got to hit 100 million within 3 years, or it's not a dud, but it just didn't work out the way you expected?
Short answer is yes. I think the longer answer is like, is there a macro reason why? Like we have fixed income products and some of the stuff on the long end of the curve over the last 2-3 years haven't been where investors have been. They've been in short term, on the fixed income curve, or they've been in equities. But if we're seeing good performance and we're seeing some adoption behind it, right? I mean, that's for us. I don't actually know a time that I can remember we've shut a fund down. Certainly not here at Neos, but we're really behind things, and we want to make sure we're putting an investment into it. But overall, yeah, got to keep an eye on those things.
Right. Now, let's say worst happens and a fund dies. Then what? What happens for the investors? How do they get their money back?
Yeah. So luckily, all that happens automatically. And actually, in an ETF structure, it's very streamlined. And so let's just say we run an S&P 500 fund. Forget options or anything for now. Just keep it really simple. If our $10 million fund had a $10 million allocation across the S&P 500, what would happen if the fund shut down was the manager would liquidate all those 500 positions, get the ETF into all cash, and the fund's administrator would distribute the cash out to everyone on their pro rata share ownership to every custodian. So nothing happens. You don't get a check in the mail. You don't lose any money. There's no crazy long-term expense accruals, right? The benefit of an ETF is it has one expense ratio. It's accrued on a daily basis. And so as soon as the fund closes, right, the money instantly gets distributed out to investors' accounts to where they held those shares.
Oh, okay. So when you confused me when you said check in the mail. What happens is the money just appears in your brokerage. And if it was S&P 500, those 500 are sold, whatever their value is on that day, you get your pro rata share of that.
Correct. Yeah, I was saying you don't get a check in the mail. You just get it all delivered and deposited right into the custody account where you held the shares.
Okay. And last question about this whole assets under management thing, because I know some people like to jump into new funds and they can be really small or big. And then some people like the big brand names. Some people like the more boutique type names. Do you see examples of two funds that are similar in terms of their strategy and the underlying index and everything? And we're talking about covered call funds, where the bigger one underperforms a competitor that does the same thing but is much smaller.
Yeah, we actually see that quite often in this industry. What you'll see from ETF issuers are if somebody comes up with a good idea, tends, and it starts to attract some assets, it tends to get competition and other managers wanting to do something very similar and get out there. Those managers might be smaller than a JP Morgan or a Goldman Sachs or some very large, significant, well-known brand. And you could see that their performance might be done differently, which could be viewed as better, but they don't have the size and scale that those other firms do for distribution. And so not as many investors ultimately are made aware of that product being offered. And you could see those at much smaller AUMs, but overall better performance if you're thinking just long-only growth and total return.
Right. You probably wouldn't want to name an example, but I can think of JEPI from JP Morgan. Not a direct competitor to SPYI, but both. Well, yours is SPYI is absolutely based on the S&P 500. JEPI is loosely based. JEPI is 8 times bigger. Last time I checked, it's huge. I think 40 billion plus. But performance-wise, it's not 8 times better in terms of performance.
Yeah, that's correct. Not talking about, us to JP Morgan, but it's a good example of showing, right. Certain firms can obviously have much more size and scale within their products, relative to, to others. And especially you certainly see that in more entrepreneurial firms like a Neos versus, right, a major global asset manager with 100-year history and a global brand. So I think what I always tell investors though is like, do your homework, right? Do your research. As all the questions you had just asked me, right? It always begs the question that investors should understand what they're investing in. Is it exactly what they're trying to espouse from their investment view? Don't be afraid of a smaller entrepreneurial issuer or a newer product, especially in an ETF, because there's, right, it's a publicly listed fund. It has a flat expense ratio, right? There's a lot of benefits that maybe investors think that either older mutual fund styles or private funds, right? You get more expenses built up, and to not go down a whole rabbit hole, I think is, definitely you see that. And ultimately, I think it's worth investors doing their research on what they're looking for within their portfolio.
Yeah, I guess we just kind of in a roundabout, long-winded way said that when you see a fund is huge, has massive assets under management, doesn't necessarily mean it's the best fund in the category.
Well said.
Okay, let's wrap it up with some fun stuff then. Or at least I find this the fun part. Your pipeline. What is it that you're working on now that's either coming out immediately or in the near future that you can talk about?
Sure. Well, I definitely think this is the fun part as well. We love being in the research shop, building, more products and solutions for investors to help them in their portfolios. But very shortly, we'll have an international high income product coming out. So in the next few weeks here. So we're excited about that. That's going to give you exposure to international equities, non-US with that high income overlay, that covered call overlay.
I think that'll do well.
Yep. Well, thank you. We hope.
I think there'll be a lot of demand for it, put it that way. I don't know what the performance will be like because that's up to the stocks, obviously. But I think there'll be a lot of interest in that. That's a hot topic right now.
Yeah, we've kind of heard the same. So we wanted to just make sure we're delivering on that solutions based. Another product we have in registration waiting to gain approval on is an Ethereum high income. So a follow on to our Bitcoin BTCI. So just exposure for people to allocate into Ethereum. And then what we've also more recently filed for that's going to be a little bit further down the road until we get approval is giving investors exposure to our SPYI, QQQI, or BTCI with a little bit more higher octane, right? And so we're allocating a little bit more in the form of, boosting is what we're calling it. We're going to basically boost the ability for people. So you could look at making a little bit higher allocation to SPYI, QQQI, and BTCI, or you could take the core version or a hedged version. It just lets investors espouse their views on the risk they want to take within kind of overall equity markets. And so can certainly talk about that as it gets closer, but we're excited about that, and that's in registration. So that's all we have out there at the moment, and our core focus for kind of the next 6 months.
Wow. Okay. So that's 3. And that last one, then it will be higher risk, higher volatility, and then potentially higher return.
That's correct. Yeah. We're going to target around a 1.5 times return of, say, SPYI. So you're going to be able to generate, seek to generate, of course, higher total returns, higher income, but you are taking higher risk and volatility with that.
Right. And you've got some funds we haven't actually talked about in any interviews that are much lower risk, lower return. So it's quite a mix there. Okay. So that's 3 to look forward to, which means we'll probably be doing another interview sooner rather than later. But I, as always, appreciate your time, appreciate you pulling back the curtain on all of these kind of behind the scenes aspects of covered call funds.
Yeah, appreciate the opportunity to be here, and always happy to come on to talk and help educate.
Terrific. Well, that wraps it up for this behind the scenes look at covered call funds. More Armchair Income coming soon.
Armchair income. That's my hustle and my groove.